Right now, as we watch the live tick on the screen, Oracle Corp, ticker symbol ORCL on the New York Stock Exchange, is trading at exactly $200.68, showing a significant intraday decline of $4.29, or roughly 2.09% in the red. We are seeing a heavy volume of selling pressure pushing the stock down toward the psychological support level of $200, a critical battlefield that the bulls are desperately trying to defend. If you are watching the order book, you can see the bids thinning out every time the price attempts a micro recovery, suggesting that institutional sellers are using any momentary bounce to offload more shares. This isn't just a quiet Friday drift. This is a decisive move lower that caps off what has been a brutal month for the legacy tech giant. The expectation right now, the narrative flooding your news feeds and the chat rooms on your trading platforms, is that Oracle is effectively dead money for the immediate future. The headlines are screaming about a massive debt overload, with reports circulating about a new $38 billion loan package intended to fund data centers that some analysts worry are being built for customers who might not pay the bills. The general consensus is that the AI trade has peaked for Oracle, that the massive run-up we saw earlier this year to highs near $345 was a speculative bubble that has now burst, leaving retail investors holding the bag while the smart money exits. The fear is palpable. Investors are looking at that debt load and the rising cost of credit default swaps and thinking this is a company stretching itself too thin, too fast, chasing a cloud dream it cannot afford. But the reality, the deeper analytical angle that the panic sellers are missing, is that what we are witnessing is not a collapse of fundamentals, but a massive, capital-intensive transition that is temporarily ugly on the balance sheet, but structurally necessary for the next decade of dominance. While the market sees that $38 billion in potential new debt as an anchor that will drag the stock down, a contrarian view suggests it is actually a defensive moat. Oracle is not borrowing money to keep the lights on. They are borrowing to build physical infrastructure, sovereign AI superclusters that no other competitor, not even the giants in the space, can deploy with the same networking speed right now. The market is pricing in a bankruptcy of ideas, but the reality is that Oracle is building the railroad tracks for the next industrial revolution while everyone else is still arguing over the price of the train tickets. When you look at the chart over the last 3 months, the picture is admittedly grim for the short-term trader. The stock has plummeted nearly 30% from its September all-time highs, a technical breakdown that has shattered the confidence of the momentum crowd. We saw the price slice through the 50-day moving average like it wasn't even there, and now it is testing the 200-day simple moving average, a line in the sand that often determines the difference between a correction and a bear market. The selling has been relentless, exacerbated by a downgrade from analysts at Davidson who cut their price target significantly, citing concerns that the massive backlog numbers Oracle reported, specifically related to that $300 billion figure tied to OpenAI, might be less firm than they appear. This created a crisis of trust. In the world of high finance, uncertainty is worse than bad news. When investors don't know if a $300 billion contract is hard revenue or just a wish list, they sell first and ask questions later. But let's pause and look at the broader context of the sector. If you were to open your Fidelity Investments account or check the charts on your Schwab Intelligent Portfolios, you would see that this rotation isn't entirely unique to Oracle, though the magnitude is more severe. We are seeing a general cooling off in the hardware and infrastructure trade as the market digests the billions of dollars in capital expenditures that have been announced. Compare this to the price action in NVIDIA stock, or even Tesla stock over the last few weeks. There is a distinct shift from growth at any cost to show me the return on investment. The difference is that while NVIDIA sells the shovels, Oracle is building the mine. The risks are different. If the mine collapses, the shovel sellers still made their money. Oracle has to make the mine productive. That is why the debt fears are stinging so much today. But here is where the smart money might be looking at a different horizon. The selling we are seeing today at the $200 level feels capitulatory. When you look at the options flow on platforms like Interactive Brokers, you can see a spike in put buying, which often signals peak fear. Retail traders using the Robinhood app are likely seeing their stop losses triggered right now, cascading the sell-off. But institutional accumulation often happens in these dark pools of liquidity where the retail investor fears to tread. The core argument for the bulls remains the networking advantage. Oracle's cloud infrastructure, unlike the traditional setups at Amazon or Microsoft, utilizes a specific type of RDMA, or remote data memory access networking, that allows GPU clusters to talk to each other significantly faster. In the world of training massive AI models, speed is not just a luxury, it is the only metric that matters because time is the most expensive cost. Let's talk about that debt again, because it is the elephant in the room driving this minus 2.09% drop. The reports of a $38 billion financing vehicle to build data centers explicitly for OpenAI is a staggering sum. To put that in perspective, that is larger than the entire market cap of many S&P 500 companies. The bears argue that if OpenAI's demand falters, or if the AI hype cycle cools, Oracle is left with massive interest payments and empty server racks. This is a valid fear. However, the counterargument is that data centers are the new oil refineries. The demand for compute is not going away. It's becoming a utility. By leveraging up to build this capacity now, Oracle is betting that they can lock in customers for decade-long leases. It's a real estate play masquerading as a tech play. They are essentially becoming the landlord for the digital brain of the future. We also need to address the sovereign AI narrative, which has been a key talking point for Larry Ellison. While most US-based investors are focused on Silicon Valley, Oracle has been aggressively signing deals with nation-states, countries that want their own AI infrastructure within their own borders for security reasons. This is a market that competitors like Google and Microsoft have a harder time penetrating due to their massive centralized public cloud architectures. Oracle's ability to deploy cloud regions that are completely isolated and secure is a winning strategy in a geopolitical landscape that is becoming increasingly fractured. This revenue stream is stickier and less sensitive to interest rates than the commercial sector. Yet the market is currently assigning zero value to it, focusing entirely on the scary debt numbers. Now, I want you to engage with this idea. Comment below how many shares of Oracle stock you currently hold, or if you sold during this recent drop. Do you think the debt load is a deal breaker, or is it just the cost of doing business in the AI age? I want to hear your take on whether Larry Ellison is a madman or a genius for doubling down when rates are this high. Moving back to the technicals, the $200 level is absolute critical support. If we close below this today, the next major support zone doesn't kick in until around $185, which was a breakout level from earlier in the year. The RSI on the daily chart is approaching oversold territory, which usually suggests a bounce is imminent. But oversold can stay oversold for a long time when the fundamental narrative shifts this negatively. We are also seeing a divergence in the MACD, where the momentum to the downside is accelerating. This is a falling knife. Trying to catch it requires nerves of steel and a belief that the market has fundamentally mispriced the risk of the OpenAI deal. It is also worth comparing Oracle's current situation to what we saw with Apple stock a few years ago during the tech wreck. Everyone doubted the services revenue transition, focusing only on iPhone sales. Oracle is going through a similar identity crisis. For decades, it was a database company. It sold licenses. It was boring, profitable, and safe. Now it is trying to be a high-growth utility company. This shift ruins the models that Wall Street analysts have used for 20 years. They don't know how to value a company that has the growth profile of a startup but the debt profile of a utility. This confusion creates volatility, and volatility creates opportunity for those who understand the underlying mechanics. If you are a self-investing individual, perhaps using SoFi Invest or managing your own individual brokerage account, you have to ask yourself what your time horizon is. If you're looking for a quick flip, Oracle right now is a dangerous game. The momentum is clearly bearish. But if you are looking at online investing through the lens of a 5-year hold, you have to wonder if buying the premier builder of AI data centers at a 30% discount to its highs is a gift. The risk is execution. Can they build these centers fast enough? Can they manage the cooling costs? There is a lot of talk about